Hi there. Thanks for tuning in. Today we're going to be doing an analysis and valuation of iRobot Corporation. Let's get started. Now, iRobot Corporation is a maker of vacuum cleaners, essentially the robot vacuums, such as the Roomba and other models that they have. They're the biggest company of this sort, and they are public as the ticker symbol IRBT. And recently, Amazon announced that they were going to acquire iRobot, right? And even more recently, this is news from this week of July 27th, so it was announced on July 20th ish, is that Amazon actually reduced the price at which they were going to acquire iRobot. So now they're paying $1.45 billion before it was about 1.665, $67 billion. So they reduced that price recently, and we're going to talk a little bit as to why. But here it gives you some indication, right, that they took a loan as the Amazon deal price is cut, right? They're seeking a lifeline as proposed acquisition by the e-commerce company attracts antitrust scrutiny. So let's talk a little bit first about their financials and then about the acquisition. So first of all, these are the financials for the last 3 fiscal years of iRobot Corporation. And here we're seeing quite an interesting story. We're seeing revenue that in for fiscal year 2020 and 2021 seemed to be pretty healthy and then went back down in 2022. We're seeing gross profit that's actually ever decreasing, right? Cost of revenue is generally tied to your revenues, right? So the higher they are, the higher the cost of revenue will be, usually because they're your variable costs. The lower they are, the lower the cost of revenue will be. But here you'll see, for example, that in this year where they made more money, in 2020 where they made more money than in 2022, they still had a lower cost of revenue than in 2022. So clearly there's something wrong there because the gross profit has trended consistently down. Their gross profit margins are trending consistently down instead of staying consistent. So that's very, very important to note. Likewise, their operating expenses, even though revenue has been trending downwards, or at least recently, their operating expenses have been trending upwards. And basically, all of these metrics have been trading upwards, right? Their research and development, their selling and marketing, their general and administrative expenses, that is a mouthful. So, what does that lead to? That actually leads to a net loss now. They used to make over almost $150 million in net income. Now they're losing almost $300 million, right? And last year they would have lost if not for some nice provisions before taxes and some interest and other stuff that they're giving them, which are one-time things. So we're seeing a declining situation here. And let's put it here as margins, right? So we have 100% of revenue. What is left here used to be about 47% of the revenue after you accounted for your variable costs, and then that went down to 35 and now to 29.5 roughly of the revenue that is turned into your gross profit. And then once we look at operating profit, it used to be 10% of revenue used to be turned to operating profit. Now it's in the negatives, right? And the same translates over to net profit. It used to be 10% of revenue became net income. Now it's in the negatives. Now none of your profit is turned into net income, or none of your revenue is turned to net income. So that's very important to keep in mind, right? We not only have a story of declining revenues, but also of declining margins. Because your revenues can decline and your margins can stay the same, or they can even get better as you get more operationally efficient. But clearly, iRobot is going through a lot of pain right now. And we're going to look at the statement of cash flows to also see a little bit about this, because generally a lot of companies can have negative net income but have positive cash from operations. But we'll see here that they used to have positive cash from operations, and that started lowering and lowering. So now they have very negative cash from operations, which also means that they're a free cash flow negative company, right? They don't have much cash money to use, to deploy, to become bigger, to give back as dividends, to do share buybacks. They don't have any of that left, to pay down debt even. So that's very important. Now, they have less flexibility and less options when they're lacking that. And you'll see one of the bigger hits that they took here was their inventory. For fiscal year 2021, They had a lot of accumulated inventories. When you have to liquidate that, you have to liquidate it maybe at a sale. You aren't actually selling it at what you paid for those inventories, so that's important. And then here you'll see that their accrued expenses and their accounts payable actually caught up to them, and they were already coming with some net losses. So that just leads to very negative cash from operations. Subtract the capital expenditures from that, and you have very negative free cash flow. So that's not great. What do you also have here? They used to repurchase shares. Last year, they didn't repurchase anything. Of course, if Amazon is going to buy every share of the company, why would you repurchase shares, you know? And debt, they actually don't have much debt, except we'll see at the beginning of, or like recently when they acquired debt. And this is one of the first times they've ever acquired debt. But you'll see that here, cash and cash equivalents has been decreasing. So cash and cash equivalents went from $400 million to $200 million to now getting even closer to $100 million. So that's been ever decreasing. They have less cash and cash equivalents even available to them. And we see this is from their latest quarterly report released on April 1st of 2023, right? Or the financials as of April 1st, 2023. And we'll see that their assets, their cash and cash equivalents went from this $117 million to $47 million. Basically more than halved, right? Their inventories are still pretty high. They're not able to liquidate that at the amount that they want. You know, their goodwill actually has stayed the same, and that's not really an asset. That's kind of a tricky asset. So it's a significant part of their assets, but it's not really an asset because eventually you're going to have to write down goodwill and take that as a loss to your net income. So your total assets have actually gone down from $835 million to $664 million. This is concerning. We also see in the last 3 months, right, compared to that same 3-month period in the last year, that their revenue has been significantly lower, right? Their gross profit has been significantly lowered. Their operating loss has been huge, and so has their net loss. So we're seeing a company that is going through a significant and very serious financial decline. And this is reflected here. Now, granted, what you see here, this spike almost to $61, that was roughly the share price that Amazon was going to acquire it at, was that $61 level. So when Amazon announced the acquisition, it went up here. And then you saw that there was some doubt about whether or not regulators would approve it. So that's why it ended up down here, right? And then it shot back up because there was some hope. And then it shot back down because there has been some doubt as to whether regulators will approve it. And also Amazon announced that they would be acquiring it at a way lower price. Hence also why they took on debt. You see this situation here where their assets are down, where their net loss is huge and their revenues are down. They need to take on debt to even stay alive. So we're seeing declining stuff. And the only way for you to really make profit out of this company, because it doesn't even have a PE ratio because it has no earnings, is for Amazon to buy it out, right? And that's very key here. And that's what I want to tell you. It's a declining company where theoretically Amazon will buy the company at around $51. Right now it's at $40. So technically, the only way I see of making money here is if Amazon buys the company. So let's talk about risk and reward, right? If Amazon wants to buy it at $51 and right now it's at $40, then the risks are that if the Amazon acquisition deal does not go through, you're left holding a company with declining financial health and much less flexibility. The acquisition price was already lowered by Amazon. Could this happen again? Could regulators be wary of this? And is that something that would make them actually decline the acquisition? And this is a company with a lot of competition. Despite the Roomba brand, which is very recognizable, it still is very, it doesn't have a deep moat, right? There are a lot of competitors that also make robot vacuums, maybe even at a cheaper price point, maybe even they're even better, who knows? So thus a recovery in terms of their financials is not certain, at least independent of Amazon. The rewards are that from this price point, the merger arbitrage represents between a 20 to 25% gain, depending on when you buy iRobot, assuming that Amazon goes through with the acquisition. This is a great return, even if the merger takes 1 to 2 years to consummate, right? If it takes you 1 year, you make a 25% gain in 1 year. If it takes 2 years, well, on a year-over-year basis, that is roughly a 10 to a 12.5% return, which is pretty great. And if you're willing to track the FTC hearings and arguments, you may be able to gain confidence in the merger or lack thereof, right? I know the UK regulatory body actually said the merger could go through, but they're waiting on the USA. So it's very important. I personally don't see how Amazon acquiring a robot vacuum company is going to be a big threat to the American consumer, but that is just me. I am not the FTC, right? But regardless, you will have to be able to track this. If this is the only way where you're getting a reward, right, is through Amazon acquiring iRobot, then you better be ready to read the arguments that the regulators are making and read into it and see if you still have confidence of the merger going through, right? So, the point I want to leave here is that if all else fails, own a great business, anyways. Own great businesses. You know, iRobot is a company that, for me personally, looks pretty risky, right? If the Amazon deal falls through for whatever reason, you're not holding a great business. You're holding a business with everything declining that just had to take out debt before it didn't really have debt to even stay alive. So that's incredibly important to note. And when everything hinges on the acquisition, well, you better have a really good stomach because you're going to be nervous about whether or not the acquisition is going to go through. With that said, I hope that you find this video useful. I hope that you got some insight into iRobot or into merger arbitrage and acquisitions. And if you want me to look at any other stocks, feel free to comment down below. I will read your comments. I'll be very happy to. And if you like this video, please like and subscribe. It helps me a lot. With that said, I'll take up no more of your time, so I hope you have a great rest of your day.